Hello, I'm Amir Al-Hafiz, and together with my friends Farhan, Rashdan, and Maliki, we will be presenting about the sales and collection cycle. Our presentation will encompass how the sales and collection cycle relates to the management assertions, audit objectives, class of transactions, relevant accounts or ledgers, proposed internal controls, test of controls, substantive tests, audit evidence, and possible misstatements before we go into task 2.
Assalamualaikum, my name is Muhammad Farhan bin Suhaimi and I'll be explaining the management assertion that auditor use when examining the sales and collection cycles. First, we have the assertion of occurrence. The management is asserting that every sale recorded in the financial statements represents a genuine transaction with a real customer. This is crucial because fictitious sales are a common form of financial statement fraud. Next, we have the assertion of completeness. The management asserts that all legitimate sales and cash collection have been captured in the accounting records. After that, we move to the accuracy assertion. Here, management is asserting that the amounts recorded are correct in terms of pricing, quantity, and calculation. This includes applying the right unit price, multiplying quantities properly, and converting currency accurately. Then we have the assertion of cut-off. This assertion ensures that sales are recorded in the period when they actually occur, according to the applicable revenue recognition criteria. Moreover, we also have the assertion of classification. The management asserts that the sales transactions are recorded in the appropriate account within the chart of account. Lastly, the management asserts that the company actually owns the receivable shown on the balance sheet and has the legal right to collect them.
Assalamualaikum warahmatullahi wabarakatuh and a very good day everyone. My name is Amr Rashid. I am going to present about the audit objective that related to association. Okay, first of all, without further ado, let's begin. Okay, in the audit objective association that related in the sales and collection cycle are critical component of the revenue record. In this cycle, our primary goal as an auditor to ensure that all the association made in the financial cycle are both valid and also reliable. These objectives are based on management association about the transaction and also the balance. The guide in the audit procedure that we perform. Okay, first of all, I wanted to explain about the occurrence, also can be referred as validity. Our objective here is to ensure that all the recorded sales transactions are actually occurred that also are related to the entity. This is very important because the audit risk and fictitious sale could be recorded intentionally or unintentionally to initiate the revenue. So to address this risk, auditor usually perform the procedure about watching sales entries and also inspecting customer to confirmation that related to corresponding. Okay, next is completeness. Completeness, our objective is to confirm that all the sales are actually occurred that has been completely recorded in the accounting record. This related audit risk here is to understatement of the revenue and due to unrecorded sale, particularly around the period and also cut off. And to test the completeness is usually they are tracing the document shipping. Okay, nextly is we are looking at the accuracy. Accuracy is the objective to ensure that all the sales transactions are recorded at the correct amount, including accurate pricing, quantities, and also applicable discount. This risk is pricing error, quantity mistake, and also unauthorized discount could be in material misstatement. To investigate it, usually we are comparing the price checklist with the quotation and also access order. Okay, in this slide, let's continue with another two additional assertion with the sales and collection cycle, which is cut off and also classification. First of all, the cut off is the objective of the assertion is to ensure that all sales transactions are recorded correctly in accounting period, no premature and no delay. This audit risk that revenue might be recognized in the wrong accounting period to manipulate earning, particularly around the end of the year and also the fiscal year. This kind of timing manipulation can be significantly affect reported income and also mislead to the stakeholder. To address this, we review transaction immediately before and after the period end to detect any improper timing. Also match recorded sales entry with the shipping dates and also the return to reconfirm that the revenue and recognition align with the good work actually transferred to the customer. Okay, next is a classification. Classification has the objective to ensure that all the sales transactions in the property classified within the correct account. This audit risk is that misclassification can lead distort financial ratios, and also inaccurate disclosure, which in turn can impact decision made by the user of financial statement. Usually, the audit procedure that include in this section is examining journal entries to ensure that all the coded are correct and monthly. Also, they also verify the items such as allowance and discount and recorded separately and not combined with the gross sale, ensuring transparency in the reporting. Okay, for this slide, we are going to talk about existence, valuation and allocation, and also right and obligation. Okay, first of all, existence. Here are the existence is to confirm that the recorded account receivable actually exists in the balance sheet data. The key of audit risk is the receivable may be overstated, for example, due to fictitious and also duplicate balance, which would result in inflated asset position. To vary existence, we perform the following procedure. For example, like send positive or negative confirmation directly to sample the customer, and also we also review subsequent collection, payment received after the year end, and also further evidence that the what we call the ARC was valid. Next is evaluation and allocation. This assertion focus on whether accounts receivable are recorded in the net realizable value, which include the adjusting for the collectability issue. The audit here is to avoid overstatement of the receivable if the AFDD is underestimated or if uncollectible balance are not written off. Audit procedure that usually involved in this assertion is analyzing the aging schedule, assessing reasonable for the allowance, and also inspecting supporting document for the write-off. Okay, last but not least, we will go for the right and obligation. This assertion address whether the entity has legal ownership right to the receivable recorded. This risk is the company may be report receivable is no longer owned, such as for those that have been factored, pledged with the collateral, and also sold to the parties which will lead mistake in the asset. To evaluate this, usually auditor review agreement and contract such as factoring arrangement or loan covenant, or to identify any restriction to transfer the ownership. Also, they also test inquiry with the management and also legal costs regarding any pledge of assignment of receivable. Okay, as we move further into the sales calculation cycle, it's important to understand the primary classes of the transaction that are subjected to the audit, because these are financial activities recorded in the accounting system, and each class are tied for a specific addition. Okay, first of all, sales of goods services. This is the core of the revenue, presenting the entity delivery of the good or services to customer, either the credit or cash. Or the key assertion is occurrence, did the sales actually happen? Accuracy is the amount is corrected. Cut off, it recorded in the right period. Completeness, were all the valid sales recorded? And classification, was it posted to the right account? Example, a company record of the sale of finished good to customer for credit. Okay. Next, we go to for the cash receipt. This cash receipt is this class involve the payment received from the customer, typically to the bank deposit, check, electronic transfer, and also others. Okay, key assertion is occurrence. Occurrence was the payment received from the real customer. Completeness, all the receipts are recorded, and also accuracy, were the amount are recorded correctly. Okay, a customer payment in deposit and recorded in the bank ledger. Okay, that was the example lah. Okay, next we go to the sales, return and allowance. This transaction reflect return merchandise or price reduction due to defect or dissatisfaction. Okay, the key assertion that related to this is occurrence. Did the return or allowance actually happen? There are accuracy for the accuracy assertion is the return correct amount correctly, and completeness, have all the return are recorded. Okay. Okay, next we go to another three. Okay, we are focused on uncollectible account and also the treatment in financial record lah. Okay, so next we go for the bad debt expenses and also allowance for the full debt. Okay, this class of interest recognize that some receivable may not be collectible, therefore the allowance must be recorded. So the key assertion that related to this is accuracy is the estimate of the bad debt is appropriate. Sometimes they are recorded more and sometimes they are less recorded. Also, secondly, evaluation, are the receivable recorded as their net realizable value, and also completeness, have all the necessary adjustment has been made. Okay, example, management make a year-end adjustment entry to estimate the future credit loss based on the historical collection pattern and also economic condition. Okay, next we go to the last part, which is write-off of the uncollectible account. Bad debt. Once the account is deemed uncollectible, it seems to be removed from the book. This class to ensure that the write-off are authorized and also accurate in the process. Okay, key assertion that related to this process is authorization, was the right of properly approved, accuracy, was the correct amount is removed, and also completeness, have all the appropriate account has been written off. Okay, we can see in the example which is a long outstanding receivable has been written off. All exhausted, all collection are obtaining managerial need to get managerial approval. In summary, each of these transaction classes carries distinct audit risk and related the specific assertion. As auditor, we are designed to target procedure for each class to ensure that financial reporting is complete, accurate, and also according to applicable accounting standard. As auditor, it is essential to identify the specific account or ledger that are directly impacted the sales and revenue collection cycle. Each account are tied to particular assertion and require the targeted auditors. Let's review some these cycles assertion related. First of all is ARC, which stands for account receivable quarter. This is a current asset account that represent amount of owes to the company by the customer. Okay, key assertion that related is existing, valuation, right at the application, and also completeness. Existing are the receivable are really existed. Valuation are they value correctly, right? And valuation, does the company have legal right to this receivable, and also completeness are all the value receivable are included. Okay, in order to test this, usually auditors send confirmation to customer to verify the amount owed, review their aging to of receivable to identify the overdue account, and also examining subsequent cash receipt to confirm the receivable have been collected as expected. Okay, next we go for the sales revenue. Sales revenue is the revenue account which represent the income earned from the selling good or servicing. Okay, key assertion that involves is occurrence, completeness, accuracy, and also cut off. Was the sales legitimate are being recorded? Will all the sales transaction has been captured? Was the sales record have been corrected amount? And also was the revenue recorded in the correct period? Okay, in order to perform this test, auditor usually perform an analytic review to check unusual fluctuation in the revenue and also trace the sales transaction from the source document to the accounting journal. Okay, next we go for the allowance for doubtful debt. Okay, this is a contrast record that represent as estimate all the receivable of company may not be collected. Okay, the key assertion that related to this is valuation and also accuracy. Okay, in order to test this, usually auditor review management estimation method to ensure the based on solid data and also compare the allowance with the historical cost data to assess the reasonable. Next, we go for the bad debt expenses. Bad debt expenses is the expenses account that recognizing the cost and uncollected receivable. Okay, key assertion that related to this is accuracy and also completeness. Is the bad debt expenses accurately recorded and also have all necessary adjustment for the bad debt has been made. Okay, to audit this, usually auditor trace the adjustment to the appropriate approval document and also inspect the GL for the write-off and also confirm that they have properly recorded. Okay. Now let's discuss continue remaining of the key account in the sales and collection cycle. Okay. Next is sales return and also allowance. Sales return allowance is a contra revenue account with reflecting customer return the good and deducting from their sales. Okay. Usually key assertion that related to this is completeness, accuracy, and also accuracy. In order to test this, usually we matchmaking with the credit memos to the original sales invoice to confirm that return are properly linked in the correct sales transaction. Okay, next is review their trend in return and compare with their prior period to assess consistency and identify any usual pattern. Okay, last but not least is cash and bank account. Cash and bank account is an asset account that represent the actual cash in hand and in bank account, including deposit from the customer. Okay, case assertion that related to this is existing and also accuracy. Existing, does the cash balance actually exist in the state in the book? Accuracy, are the amount are recorded correctly. In order to verify this account, auditor are usually perform the bank reconciliation to ensure the cash balance are accurately reflected. and also trace collection from the account ledger to the bank statement to confirm that cash receipts are properly recorded and deposited. Okay, first thought of the for the final thought in summary, each of the account ARC, sales revenue, FDD, and also others play critical role in the integrity of financial statement. By focusing our audit procedure on the assertion related to this account, we can ensure that financial record can be reliable and also recorded accurately.
Proposed internal controls. Royal Vector's proposed internal control framework addresses critical weaknesses in sales and collection cycles through 4 key areas: enhanced credit assessment with comprehensive documentation and scoring matrices, standardized billing processes, three-way matching and sequential invoice controls, systematic collection procedures with automated aging reports and escalation timelines, formal bad debt management with clear provisioning criteria and write-off authorization levels. These controls will significantly reduce bad debt losses, improve cash flow, ensure accurate financial reporting, and strengthen overall operational efficiency while maintaining professional customer relationships. Proposed internal controls, sales cycle controls, customer setup and credit approval process. Proposed controls are: establish customer master file creation. Number 2, establish credit assessment metrics. Number 3, establish credit approval authorization metrics. The control objectives for customer setup and credit approval process are: establish creditworthiness customer base, minimize credit risk exposure, ensure proper customer documentation. For the sales order processing controls, the proposed controls are: 1. Establish sales order validation process. Number 2, establish pricing controls. Number 3, maintain accurate service records. The objectives are: ensure all sales are processed properly and are authorized. Number 2, verify customer credit limits before service delivery. And number 3, maintain accurate service records. For service delivery and documentation controls, the proposed controls are: 1. Establish service documentation metrics. 2. Establish service delivery verification. The control objectives are: 1. Ensure services are delivered as ordered. Number 2, maintain proper documentation for billing. And number 3, prevent revenue leakage. Propose internal controls for billing cycle controls. Invoice generation controls. The proposed controls are: 1. Establish invoice processing workflow. Number 2, establish invoice accuracy controls. And number 3, establish invoice numbering and control. The objective of the control objectives are: 1. To ensure complete and accurate billing. Number 2, to prevent duplicate or unauthorized billing. And number 3, maintain proper supporting documentations. And for the revenue recognition controls, the proposed controls are: 1. Establish revenue recognition criteria. Number 2, establish monthly revenue reconciliation. The control objectives for revenue recognition controls are: 1. Ensure revenue recorded in correct period. Number 2, prevent premature or delay recognition. And number 3, maintain audit trail for all transactions. And now we go for the proposed internal controls for collection cycle controls. Account receivable monitoring controls. The proposed controls are: 1. Establish daily receivables monitoring. And 2. Establish weekly aging analysis. The control objectives for accounts receivable monitoring controls are: 1. Monitor outstanding receivables effectively. Number 2. Identify collection issues early. And number 3. Maintain current aging analysis. For the collection procedures and activities, the proposed controls are: 1. Establish standardized collection timeline. 2. Establish collection activity documentation. And number 3, establish collection performance metrics. The control objectives are: implement systematic collection approach. Number 2, maintain professional customer relationships. And number 3, maximize collection effectiveness. And for the bad debt management control, proposed controls are: 1. Establish bad debt classification and provisioning. And number 2, establish write-off authorization process. The control objectives for bad debt management controls are: 1. Minimize bad debt losses. And number 2, ensure proper authorization for write-offs, and 3, maintain accurate financial reporting. Test of controls. Test of controls is a systematic approach to evaluate the effectiveness of internal controls by examining evidence that controls are operating as designed. For Royal Vectors Rembrahat, implementing comprehensive testing will ensure the proposed controls are functioning effectively and achieving their intended objectives. Test of controls framework. The testing methodology are based on three main levels. Level 1, design effectiveness. Level 2, implementation testing. And number 3, operating effectiveness. Now, for the test controls for sales cycle, the example of the tests are as follows. Test 1, credit application completeness. Test 2, credit assessment accuracy. Test 3, approval authorization. Test 4, credit limit verification. Test 5, pricing authorization. Test 6, services documentation completeness. For billing cycle, the sample tests are as follows. Test 1, invoice processing workflow. Test 2, three-way matching. And test 3, invoice numbering and completeness. For the collection cycle, the proposed tests are as follows. Test 1, cutoff test. Test 2, revenue reconciliation. Test 3, aging analysis accuracy. Test 4, collection timeline compliance. And test 5, collection documentation.
Hello, I'm Amir Al Hafiz and I'll be presenting about substantive tests and audit evidence. Substantive tests are audit procedures designed to detect material misstatements in the financial statements and ultimately produce audit evidence that supports the auditor's opinion. As opposed to the test of controls, substantive tests focus on detecting misstatements, while the test of controls focus on assessing the control effectiveness. Now let's take a look at some of the substantive tests related to the sales and collection cycle. Number one is the vouching of sales transactions to shipping documents. This helps verify the occurrence of the sale, whether it actually happened or not. An example of this is tracing sale entries to the bills of lading or the delivery order or delivery notes. Next is the test sales cutoff, where we verify the transactions are recorded in the correct accounting period, as some companies might tend to push their sales in December in the following year in January. Following that, a substantive test is to analyze sales returns and allowances. This helps verify completeness and accuracy of returns and allowances by reviewing credit memos and returning documentation. Another example would be to recalculate aging of accounts receivables. This is important as it verifies the valuation of receivables and allowance for doubtful accounts. This, for example, is in preparing aging report and recalculating the totals. As my friends have presented before, management assertions help define the audit objectives which guide the auditor in performing the procedures which ultimately produces audit evidence which can be used to support or refute the management's assertions. But what exactly is audit evidence and where does it come from? Audit evidence refers to the information used by the auditor to support their opinion on whether the company's financial statements were prepared accordingly and fairly presented. The audit evidence should be persuasive and does not necessarily have to be of absolute certainty. It should be sufficient, in simpler terms, meaning enough, and appropriate, in simpler terms, meaning good. So there needs to be enough good evidence to support their opinion. Now let's talk about where these audit evidences come from. There are three main sources of audit evidence, and the first one being the auditor themselves. This evidence would be regarded as highly reliable as the evidence is independently gathered and involves no third party involvement. Some examples that can be related to the sales and collection cycle include observation and inspection, such as inventory count and stock take, and also recalculation of the sales totals and discounts. Next source would be the third parties, which is still considered reliable as it is independent from the company management themselves. And in relation to the sales and collection cycle, this could include bank confirmations, legal confirmations from lawyers, and even external shipping documents. Lastly, the source of evidence could come internally from the company management themselves. This is considered less reliable as it is subject to tampering by the management office. This would include internal financial reports, accounting records, invoices, delivery orders, sales journals, and general ledgers.
I'll be the one to explain about the possible misstatement. First, in the sales area, a common misstatement is recording fictitious or inflated sales. This means revenue is recognized even though the sale hasn't actually occurred. For example, a company might record future sales in the current period to make its financial performance look better than it really is. Next, under receivable, the issue is not writing off bad debt. This keeps amount of the book that the company is unlikely to collect. An example is when customers who have declared bankruptcy or stopped operation are still shown as owing money. Then, under cut-off, a misstatement occurs when sales are recorded in the wrong period. For example, a company may record January 2024 sales in December 2023 to boost current year performance. After that, under accuracy, misstatement can happen when there are incorrect price or quantities billed. A common example is simple mathematical error in invoice calculation, such as incorrect total or misapplied tax. Furthermore, we have completeness. This refers to situations where some sales or receipt might not be recorded at all. A typical cause is manual recording system that have gap or weakness in procedures. For example, missing document. Lastly, classification issues occur when the revenue is recorded under the wrong account or category. A typical example is where service income is mistakenly recorded as a product sales. This misleads stakeholders and may affect performance analysis by product line or business segment.
For the task 2, we are reviewing PYQ 2022, question number 5. So we have to identify the witnesses, 5 witnesses that related to our cycle. Okay, so we are choose PYQ 2022. Firstly, I would like to highlight the internal control witnesses number 1, which is related to credit facility approval process. Okay, we also can find in the question that they are mentioning something about the prior to the approval and blah 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 until the other additional supporting document that are demanded observation. I have to cut down in order to make the time short. Okay, this is indicate that the credit approval process are relies only a self-declared information without any third party which verification or supporting document, supporting financial documents such as audit financial statement, creditor statement, also or bank reference. This impact of the witnesses is significant. It is increase the risk of granting credit to the financial unstable client, which may lead to underpayment or default, ultimately cause the cash flow issue and also increase the bad debt for the company. To rectify this, we recommend that the company implement a structured credit evaluation process. This should include requesting their verified financial statement, conduct credit historical check using a credit scoring system, for example like what we call it CTOS. Okay, this is all information that need to find in order to release the decision making. Okay, let's go for the witness number 2. Automatic credit approval for major client. Okay, you can see in the case above, previous slide. Additional, the client who give venture to highly variable project and those who are deemed as major client will be automatically granted a credit facility by the company. This practice bypass any credit worthiness assessment simply based on their perceived importance or project size. Why this client may be insignificant in the business. The lack of due diligence exposed to the company to the high value credit risk. The potential impact here is very dangerous. Assuming major clients are financially secure could backfire if they default on the payment, leading a substantial financial losses due to larger transaction value were involved. To address this, it is crucial that no client, regardless to their status, is exempted from the standardized credit assessment process. Consistency in the procedure not only ensure fairness but also protect the company from unexpected default.
A possible internal control weakness that is found is a lack of formal bad debt write-off procedures. The impacts of this weakness to the company would include uncollectible amounts may remain in the books as if they are still collectible, inflating the financial statements, and the consequences of this would be a misrepresentation of the financial health and profitability of the company, which would affect credit worthiness and the stakeholders' trust, as it may mislead the decisions that are to be made by the stakeholders. Suggestions to rectify this weakness would include developing a formal bad debt write-off policy, which would include a clear criteria of classifying debts that are doubtful or bad. For example, a policy where debt is overdue by more than 180 days, or maybe when legal action has failed and the debt is no longer collectible, or even customer insolvency. Other than that, there needs to be required documentation, for example, an aging report on the collection of the attempts that have been made and the correspondences in relation to the collection of that debt, and also approval levels for write-off, including a write-off by the supervisor or the CFO, for example. The benefits of this would be that it promotes consistency in debt collection, transparency, and also compliance.
Possible internal control weaknesses. Number one, insufficient credit monitoring and control monthly reporting only. It should be more frequent for active monitoring. Number two, no early warning system for potential default. And number three, limited proactive credit management measures. Now, the impact of the weaknesses to the company are financial impact. Number one, higher risk of bad debts due to approving credit for financially unstable clients. And number two, increased working capital requirements as more funds are tied up in doubtful debts. And for operational impact, number one, resources wasted on pursuing uncontrolled collectible debts. And number two, damage to company reputation is forced to take aggressive collection actions. Suggestion to rectify the weaknesses. Solution number one that is suggested was enhanced monitoring frequency and real-time dashboard. This will enable the company to be able to monitor and on real time the collection processes and the bad debts recurring or incurring on the date. Solution number two would be early warning system implementation. Now, this will help up company in identifying or taking proactive action should the early warning trigger due to default of payment. And number three, solution three would be proactive credit management system, which basically means that they will regularly validate and evaluate all potential clients to make sure that there are credit worthiness and that all the amount of discounts or payment terms are based on the client's credit worthiness.
Last but not least, we have identified a critical internal control weakness where a single clerk is responsible for both processing shipment documents and issuing job order. This creates a high risk of error or even fraud. When the same person controls both steps in process, especially one involving the movement of goods, there is no internal check. For example, someone could create and process a fake job order and then ship goods without proper oversight. This could lead to a financial loss, inaccurate records, and loss of inventory control. To address the issue, we propose two key solutions. The first solution is to implement segregation of duties. This means assigning different personnel to handle shipment documentation and job order creation. With this division of tasks, it becomes much harder for fraud to occur undetected, and it also reduces unintentional errors. The last solution is to use system-based approval workflow. Even if full segregation of duty isn't possible, say in a small business with limited staff, we can implement a digital system where any job order or shipment cannot be complete without approval from another user. This ensures that every transaction passes through a second level of review and leaves behind an audit trail. It's especially useful in modern environment where automation support internal control. Both solutions aim to strengthen the reliability, accuracy, and integrity of the shipping and job order process, helping the company reduce risk and operate more securely. That's all for my presentation today. Thank you so much for lending your ears.